It is early April 2026, and while most retail investors are still looking at their portfolios with hope, a drama is playing out on Wall Street that, in my opinion, could go down in the history books as one of the biggest losses of wealth of all time. An unbelievable $4.5 trillion in value has been wiped out in the US stock market. This is no longer just a correction. In my view, this is a fundamental revaluation of the world power that is the USA. Right now we are at a psychologically very critical level where, in the past, buyers repeatedly rushed into the market in a big way to buy the dip. But this time it feels different. If this support breaks, we could, from today's point of view, see moves in the coming weeks that could even overshadow the volatility of 2008 or 2020. And it does not only affect the S&P 500. The Nasdaq 100, once the driving force of the tech rally, is in an almost identical and highly vulnerable position. The question everyone has to ask now is this the ultimate buying opportunity of the year or the beginning of the end of the current bull market? Today I will show you the hard facts behind this chaos, why Donald Trump's latest attempts at de-escalation in Iran may, in my opinion, be too little and too late, and which mathematical rule is, in my view, currently threatening your portfolio. Important before we start, this is not financial advice, only my personal opinion based on the current available data. Let's not waste any time, let's get started. In the last week, Donald Trump tried everything to force a ceasefire with Iran. His goal: to reverse the massive economic damage that has happened since the conflict began. And in fact, right after Trump's first announcement, the oil price dropped by around 9%. Many media outlets already celebrated this as a turning point. But let's look at the reality instead of just reading headlines. Despite this drop, oil is still trading almost 100% higher than before the outbreak of hostilities. So the energy market is anything but calm. In my view, it is still on highest alert. And this is where the real problem lies. The one almost everyone is missing right now: the time delay in the data. The official inflation data for March will only be published in April. This means the market is basically flying blind right now. We know that headline inflation in the US is heavily driven by the oil prices. Oil is not only a direct part of the consumer price index, but also an indirect input cost for almost every good and service we consume. From logistics to fertilizer production, everything depends on energy prices. While rents or insurance usually move only slowly, oil is highly volatile. This jump in oil will, in my opinion, very likely push US inflation in the next release on April 10 up to 3.5% or even 4%. If that happens, the way the entire US stock market is valued will change fundamentally and suddenly. By the way, if you enjoy this deep analysis, I would really appreciate a subscription. It supports this channel a lot and makes sure that you don't miss any updates during this critical phase. Thank you. Why have we been so optimistic about stocks over the last 3 years? Very simple. Inflation kept falling. Falling inflation has historically been the fuel for some of the strongest market rallies in history. But within just a few weeks, the whole picture has changed. Inflation is the center of the financial system. It decides whether an asset class is attractive or not. Imagine you invest 100 euros in a company. This company earns 5 euros per share, so your return is 5%. If inflation is at 2%, your real return is 3%. That means you're getting richer in real terms. But if inflation suddenly jumps to 6%, your real return becomes minus 1%. So you're losing purchasing power even though your portfolio looks the same on the surface. This exact shift is happening right now with the S&P 500. At the moment you pay around $6,600 for one share of the S&P 500. The companies in the index together generate around $235 in profit per year. That equals an earning yield of around 3.5%. At the start of 2026, inflation was on average around 2.5%, so we had a real return of 1%. That was okay. Investors did not need to worry about valuations. But if inflation now jumps to 4%, the real return of the S&P 500 turns negative. And that, my friends, is historically, in my view, a serious warning sign. Look at the data. Since the 1960s, there have only been a few moments when the real earnings yield became negative. For example, 1987, 1999, 2007. Do these years sound familiar to you? every single time a bear market followed, with losses of at least 20% or much more. Of course, historical patterns are no guarantee that the past will repeat itself exactly, but in my view they clearly show how sensitive the market reacts in phases like this. As soon as investors realize that they are losing real money with stocks, many of them start selling. Then valuations suddenly matter again. But let's stay objective. Is there, in my opinion, a scenario where the market can still move higher? Yes, there is. If the oil price falls quickly and sustainably below the $80 mark per barrel, that would clearly weaken my current view. Why $80? If we look at the last few years, we can see a clear pattern. Every time oil was above $80, the S&P 500 came under pressure. Every time it was below that level, stocks moved higher. For me, $80 is the imaginary line between fear and confidence. If the price drops quickly, the inflation shock might only be temporary, and high valuations might hold, but, and this is a big but, there are structural forces pushing raw material prices higher, completely independent of the war in Iran. In my opinion, we are in a long-term commodity cycle. Historically, commodities move in waves that last for decades. When prices stay low for a long time, too little gets invested, which often leads to shortages and rising prices later on. That is exactly where we could be right now in my view. The current market share of commodity ETFs is currently only 3%. For comparison, in 2011 it was at 12%. That means there is still, at least in theory, huge room for capital inflows into this sector, which could structurally push prices higher. On top of that, we are seeing how the US dollar is losing purchasing power because of massive debt, which is reflected by the exploding gold price. So inflation may be here to stay. That is why I remain very careful with traditional US stocks and especially with overvalued tech stocks, as long as oil does not turn lower in a sustainable way. While the broad market is bleeding, we are shifting our focus to the areas that could, in my opinion, benefit from this chaos. There are sectors that are seeing pullbacks right now, which in my view could be very exciting in the long term. First, energy infrastructure. If commodity prices rise, electricity costs also rise in simple terms. Companies that own this infrastructure could benefit from that. On top of that, they may benefit massively from the expansion of AI infrastructure, which will consume high amounts of electricity. Second, the nuclear sector. Big tech giants are talking more and more often about nuclear power as a possible solution to their energy hunger. For me, this is a megatrend that is only just starting to warm up. And third, industrial metals, especially copper. Demand for copper will likely rise sharply because of electrification and grid expansion, while the copper price compared to gold is trading at a historical all-time low. In my view, a huge mispricing may be happening here right now. Companies that mine these metals could see profit growth on a scale that many people today still cannot even imagine. Those who position themselves smartly now will not get hit by this chaos. They will benefit from it. Do not forget to leave a like and subscribe if you want to hear more about exciting stocks from these sectors. And feel free to watch this video if you want to see more about our latest silver and gold update. And our last video. Have fun, and with that, bye.